Hello, my friends. Today we have another exciting topic about how to build wealth through real estate investing. Keep in mind the information shared in this video is for educational purposes only. Any investment involves risk. Consult an investment professional or CPA before making any decision or taking action based on the information shared in this video. My special guest today is my wife, Ling. While I'm passionate about food, Ling has just as strong of a passion on ways to build wealth to achieve financial freedom. She looks for ways of increasing our income and reducing expenses. She has spent many years researching, analyzing, and putting into practice many investment and money management strategies. She is now at a stage in her life where she wants to share some of her technical and tribal knowledge to all of you. In this session, she is going to break down the four different income streams that you can gain from owning rental properties. Welcome back, Ling.
Glad to be back, Hapa Bob.
Oh, so how many years have you dabbled into real estate, specifically rental properties?
We purchased our first rental property back in 2008. At that time, we really didn't know what we were doing. Throughout the years, we have learned a lot. Today, I'm going to share the four income streams from owning a rental property. Hopefully, you find it useful.
Very nice. I'm excited to hear you go over those income streams. Now, if any of you have any questions on your mind, please ask in the comments below, and she'll be sure to answer them. Also, please make sure to watch this until the end as she added a bonus slide on the power of leverage. All right, let's get at it, Ling. Let's get into the first slide. Income stream number one, passive income from rent.
The first income stream is the most common reason why investors get into rental properties, is to receive the passive income from the monthly rent. So let's first define what passive income is. Passive income to me is very different than our ordinary income from W-2s from our regular employers, where you have to spend at least 40 hours per week to contribute to your work. The passive income is month-over-month rental income that you earned from renting out your properties. You should spend very small effort or work towards managing the rental property. It could be 5 hours per week or 10 hours per week. I'll just take an example of the condo that I purchased in 2018. Back then, the condo that I purchased was for $125,000. I saved up enough of the cash, and like I said, I didn't know what I was doing. Once I have enough of the funds to purchase the condo, paid the entire $125,000. After that, I rented out for $1,100 per month. I also have to pay all the expenses that's associated with the house, such as property tax, landlord insurance, homeowner association fees, and management fees. In addition, I also put $150 on the side for any maintenance or fixings in case things break down. Then I can take money out of the maintenance bucket to pay for those expenses. So the math looks like this. The monthly income cash coming in was $1,100, and minus all of the cash that going out for all the expenses, $519, which would net me a positive profit of $581 per month. In summary, if I use the monthly cash flow of $581 multiplied by 12 months, that's a total of $6,972 per year passive income.
Okay, that's interesting. So this is truly passive income because you have here management, $88. So based upon that, I assume that you have like a property manager who watches over the property and like finds tenants for you, manages any issues the tenants may have. Is that correct?
That's correct. While my property manager helps me with the day-to-day operations, I still manage my own bookkeeping and decide who to rent out to, how much the rent should be. My primary focus is really to identify and analyze which opportunities that I should be moving forward with. And the income stream number one, passive income, is the most important data that I use to help me decide whether to move forward with purchasing the asset or not.
Okay, so income from rent, income stream number one, this is the income stream that most beginning investors know of, right? I'm interested to see what the other income streams are. Okay, on to income stream number two. I see here you listed value appreciation. Tell us a little bit about that.
Property value appreciates year over year. The amount of appreciation can vary, and that is dependent upon your local market condition and the location. If you're in a market with very little supply, but with huge demand because people are moving into the state because of the job relocation or weather conditions, then likely you are going to see a huge appreciation increase. I don't usually use appreciation as one of the factors to help me determine if I should purchase the asset. However, I do keep track of how much the property has appreciated or the current market value to help me determine if I should be doing refinancing or selling the property to maximize my return. I will use the same condo as an example to demonstrate the appreciation value increase. So the condo I purchased back in 2018 was $125,000. At end of the last year, 2021, the same square footage and floor plan in the same complex condo was selling for $240,000. So over the short 4 years time frame, the condo has appreciated $115,000 in value. Now, of course, you cannot expect this kind of return to continue to happen. However, based on statistics, back in 2000, the average home price was $165,000, and fast forward 22 years later, today's market house average $428,000. If you are a long-term investor and plan to hold on to the property in the long term, the appreciation will be there because of inflation.
So far you went through two income streams. The first income stream is passive income through rent. The second income stream is appreciation in the value of the property. Now, both of the income streams, most novice investors know of. Many probably do not know income stream number 3 and income stream number 4. Let's talk about the third income stream, building equity with OPM. What is that, and what does OPM stand for?
Sure, OPM stands for other people's money. I did not have the chance to do this with this condo since I purchased it outright with cash. Now, assuming I didn't do that and I actually got a mortgage, meaning I am using other people's money, I'm using banks' money to help me build equity. So how does that work? Whenever we take out a mortgage, we usually put down a percentage as down payment, and then the rest from the bank borrow the money and pay them back the principal plus interest on a monthly basis. Assuming I put down 20% down for this property, which is $25,000, and I financed the 80%, which is $100,000. And at the rate of 5% for 30-year fixed mortgage, my principal plus interest would be $537 per month. Out of the $537 per month, a portion goes to pay down my principal, and the other portion goes to pay to the bank for the interest amount. So as I continue to use the rent money to pay for the mortgage, I'm essentially paying down my principal. By paying down the principal, it's actually helping me building the equity in the house. As you can see in the graph below, the principal amount is in the green bar. It would go from 100,000, gradually go down to 0. And the orange bar is the representation for equity. I wouldn't have any equity from day one, so the equity line will slowly increase from day one through the end of the year 30. And that's how you build equity with other people's money. In this case, using bank's money to purchase the property and use the tenant's money to pay down the principal. Coming back to this condo as a summary, assuming the house value remains the same as $125,000, after 5 years owning the condo, the equity that has accumulated would have been $41,000. And that is to add the initial $25,000 cash down payment plus the $16,321, the principal pay down amount, which equates to the $41,000 equity. Does that make sense?
Oh yeah, that makes a lot of sense. So this is truly how you can build wealth over a period of time. You're not going to be able to do it overnight, but time in and time out, month in and month out, you're collecting the rent, you're paying your mortgage balance down with other people's money through the rent, and before you know it, your house is paid off. All right, we are down to the last income stream, tax savings. This is a slide that many people probably don't know much about. If you could do me a favor, Ling, and slow down, be very clear on this slide here and explain to everybody how this works.
Income stream number 4, tax savings, was the area that I never paid attention to and didn't understand. Until recent years, I realized tax play a big role in your overall portfolio management. That's why I wanted to share this income stream with the audience of what I have learned. Let's start with the operating expenses. As I mentioned previously, there are costs and expenses that are associated with owning the property, such as property tax, insurance, utilities, property management fees. These amounts directly reduce your top line from the monthly rent. If you have mortgage, the mortgage interest is also deductible. And outside of these direct expenses, if you have any other travel, automobile, cell phone, Wi-Fi, home office, these can also be deductible on your tax return. The last item is depreciation. This is one of the big items in filing taxes. IRS recognized because of the normal wear and tear of the property, they allow you to take a deduction to reduce the value of your house on paper. Essentially, this is a paper loss you are legally able to claim on your tax return. If you want to understand how depreciation works in detail, please leave me a comment below so that we can create a separate video for it. When you add up all of the expenses, including the paper loss, the depreciation, it may seem that you potentially would have a passive loss on paper, especially if you own multiple properties. And this is a good thing. Why is that? Because potentially you can use the passive loss to offset your active W-2 income. Now, there are very strict rules about how much you're able to deduct the passive loss. On the high level, for most of us small investors who have an active job and owning the rental property on the side as passive income, we qualify under the non-real estate professional. And if your adjusted gross income is less than $100,000 per year and you're qualified as an active participating in your rental business, there is definition how you can qualify, then you are able to deduct up to $25,000 in passive loss. For example, if your income is right at $100,000 mark and for that particular year you had $25,000 in passive loss, for that year, you are able to reduce your taxable income from $100,000 to $75,000, which means you only pay tax on $75,000. The other category is for real estate professionals. If you're qualified as a real estate professional, you are able to deduct 100% of the loss as opposed to the $25,000 cap for non-real estate professionals. I will have a separate video to talk about this topic specifically. Some of the long-term investors who have held on to the property for a longer term, when they decide to sell, they realize they may incur a capital gain tax. And there are tax strategies to defer the capital gain tax, such as 1031 exchange. If anyone is interested in how 1031 exchange works, let me know. I have done a few in the past couple of years.
Before we go into the last slide and talk about the power of leverage, if you haven't already done so, please subscribe to this channel so we can continue posting more videos like this. Smash the like button and also hit the bell for notifications. Thank you. Okay, and on to the last, but probably one of the most important slides here. You have here the power of leverage. Knowing you, Ling, you're not a big risk taker. You're more like risk adverse. Anytime I see leverage, it usually equates in my mind to risk. You're not the kind of person who like to take risks. Please share with us, what does the power of leverage mean in real estate?
You are correct in saying that in general, I'm a pretty conservative person. I think the important thing here is I wanted to share what I have learned over the years so that our audiences can make an informed decision when it comes to real estate investment. And based on your own tolerance level, what option or what strategy fits your best need. So let's dive right into the detail. I'm going to use the same condo as an example to compare the two strategies, person A versus person B. They both have the equal amount of capital, which is $125,000 to start with. Person A purchases 5 different properties at $125,000 each. Instead of paying the properties all in full in cash, this person put down 20% and financed the rest 80%. With a 5% interest rate for 30-year fixed mortgage, the monthly principal and interest would be $537. So the math looks like this. For person A, the total debt amount this person carries is $100,000 multiplied by 5 houses, which is $500,000. The incoming rent would be exactly the same, which is $1,100 times 5, which equals to $5,500. After mortgage and other expenses, the net rental profit per month person A receives is $215. If we multiply that by 12 months, that gives person A the total annual passive income of $2,580. On the right-hand side, person B only purchased one single condo and pays the entire $125,000 in cash. In this case, person B really has no debt whatsoever. The incoming rent is the same as $1,100. Person B doesn't have any mortgage payment, only has the expenses of $520. So when you compare the annual passive income from the rental, it looks like person B is doing better than person A because the annual passive income of $6,960 is much greater than the $2,580. Where this math will start to make a huge difference is in equity after 5 years, as well as appreciation value. Let's fast forward 5 years. Person A, by using the rent from the tenant to pay down the principal portion of the mortgage, per house, in 5 years' time, person A would have paid down $16,321 towards the principal amount. And if we use that multiplied by 5 houses, plus the original initial investment or the down payment for all 5 houses of $125,000, after 5 years, person A would have a total of $206,000 in total equity. Now, let's compare to person B. Since person B purchased the condo in cash 5 years ago for $125,000, the entire $125,000 remains the same as the equity for the condo. So now it's very clear, if we're only comparing equity after 5 years, Person A has $81,000 more equity than person B. So the lesson here is when you're getting ready to purchase a property and you're trying to decide whether to pay for cash or take out a mortgage, you have to ask yourself what your purpose of owning the real estate. If you're looking for cash flow to supplement your current income, then perhaps paying the property outright with cash would generate you more profit and you would have a more cash flow. But if you don't need the cash flow and you're really trying to build a wealth for long term, then taking out a mortgage can help you build that equity over time. The last comparison is appreciation value. Now, please remember, the housing market has significantly increased in value for the last few years. We cannot expect the same kind of rate of return to continue. But I do wanted to show you this example as demonstration purposes only, because sometimes leverage do pay off. So the comparison math looks like this. Person A decides to sell all 5 houses after 5 years. As I mentioned, at the end of 2021, the same kind of condo in the same complex was selling for $240,000, so that's the amount we're going to use. And the mortgage amount should be less than $100,000 since person A has paid down the principal amount, but for math purposes, we're just going to use $100,000 remaining. And if we use the total sale price of $240,000 minus $100,000, let's put aside the closing costs, the commission, and the capital gains. Person A is able to walk away with $140,000 per house. Multiply that by 5 properties, that's a total of $700,000 in cash. On the right hand side, if person B decides to sell the condo, let's still put aside the closing costs, realtor commission, capital gain, etc. Person B is able to walk away with $240,000. That's still a great investment, but the point here is the power of leverage has helped person A in this example achieving maximum return.
Thank you, Ling, for sharing your technical and tribal knowledge on how to build financial wealth through rental property investing. I hope some of you were able to put some money into your back pockets after watching this video on the 4 income streams of real estate and the power of leverage. If you haven't already done so, please subscribe to this channel so I can continue posting more videos on food, fun, and finance. Smash the like button, hit the bell for notifications. See you all very soon. Bye.